Well, hi everyone, Sean Humphries here. Welcome to All Things Retirement. In this installment, we're going to talk about the wisdom of uncertainty. So uncertainty implies surprises, volatility, things that are unexpected or maybe we don't want to have happen. So this last little while has been extraordinary. So at the time we were doing this video, we just come through massive impacts to capital markets because of the COVID-19 virus, the pandemic, the ultimate shutdown of the global economy, and of course capital markets responding. Now, when we go through times like this, there's some lessons that we need to remind ourselves on. We'll take a look at those lessons. Now, if you are new to this channel, make sure you hit the subscribe button. We're posting content all the time, whether you are in the planning phase of retirement, about to transition into retirement, or already retired. You'll get good value from the financial topics, but not just financial topics. We talk about health and longevity, relationships, recreation, quite literally all things retirement. So the chart that I'm going to show you is a chart that goes from 1980, if you go from the left to the right, 1980 through to 2014, so it's pretty up to date, pretty current. And I've had the great privilege of being in the financial services industry for 30 plus years, so a good chunk of this chart I've been in the business, and I've had the experience of going through the highs and lows of capital markets. Now, one of the things that this chart will show you right away when you look at it is that the blue bars, which are above the 0% on the chart, there's many more of those bars from 1980 to 2014 than the orange colored bars, which are below the 0% line. Those were losing years. Now, there's some interesting lessons to be learned from this chart. So the first thing that I would draw upon is that there's more winning years than losing years. And in previous videos, we've talked about that. 75% of the time the market's up, 25% of the time the market is down. Now, we don't know, we don't have a crystal ball as to when those times are going to hit, but when they do hit, there's some lessons embedded in them. So the thing that I would draw your attention to would be the red dots with almost every single year that's on this chart. And what the red dots represent are the intra-year declines within the calendar years. And what you see is, for virtually all those years, there is a point at which within the year that the market's in negative territory. And sometimes very significant negative territory. But even in the positive years, that's happening. But by the end of the year, the calendar year is positive. Now it's not in every year. So if you go to a year like 1981, and many of you remember the high interest rates in the early 80s, and you can see that at the worst case, that red dot was pretty low. It was, not at minus 20%, but pretty close. And by the end of the year, the market was down 10% as an example. Another interesting year was in 1987. I was in the industry at that time working for a trust company. The trust company that I was working for happened to have a large mutual fund block of business. We had GICs, and of course GIC rates were pretty competitive at that time. But we also had mutual funds. I'll never forget Black Monday. There was a few days in the market where the market went down well over 30% just in a very short period of time. So within that year it was down over 30%, as you can see in the chart, and we had pure panic in the branch. People were coming in the branch first thing in the morning, cashing out their mutual funds, buying GICs, and just taking that 30% hit on their portfolio. But what was interesting is, by the time we got to the end of the year, 1987 was in positive territory. Now, you would not have bet that. Most people were pretty pessimistic about that happening, but in fact, the year was positive. So we have other years like that. So you can see that 2008 was a horrendous year. We then saw in 2009, the first part of the year in 2009 was very negative by the red dot you see there. And then by the end of the year, we had a very large, significant gain in capital markets. So there's intra-year declines almost every single year, even in years where markets are pretty strong. And so if you're trying to make investment decisions based on the volatility through the year, it can be pretty unnerving, and it's not really a high probability decision to be using those short-term volatility points in the year as a proxy for how to make decisions. So what can we learn? Well, the first thing is the message of uncertainty teaches us that 28 out of the 35 years on that chart were positive. The average intra-year decline was approximately 14% to the negative, and if it was accrued every single year as an average. The average return over the entire 35-year period was 9% a year, and the cumulative return over that total period was 1,819% over that time period. In the short term, the stock market is a voting machine, but in the long run, it's a weighing machine. Now, what do we mean by voting machine? Well, voting sometimes is a popularity contest. Sometimes it's the game of momentum. It's not a really good way of assessing the true issues within any political system at any given time. It's very fickle. But the market very much is a weighing machine. Over time, as the data comes in, as we look at economic data, we look at spending, GDP, geopolitics, all that data gets weighed and becomes a very good proxy for the true value of the market over time. So that's the wisdom of uncertainty. More often than not, the market's going to be positive. Yes, every once in a while it's going to be negative. The high probability decision is we're going to get a positive year to recoup value from those negative years. Now, the reason these lessons are so important is embedded in this chart, and it's really looking at the U.S. markets over an extended period of time. That time period was over 20 years, ending December 31st, 2012. And the basic idea here is that if you look at the broad U.S. markets, they were up about 8.21% over that time period. But if you look at the average equity investor who was investing during that time period, their returns ended up being about 4.25%. So a real big difference. And what the study, which was done by Dalbar, a very large research group, what they concluded was that it was an investor behavior penalty. In other words, people were doing things from a behavioral standpoint that was getting in the way of getting the performance that they were trying to achieve. Now, I was doing research in preparation for this particular video, and I came across some absolutely staggering information about a particular portfolio manager that many of you may be familiar with, and I'm just going to go through the data with you. So let's see if I can find it here. So a dramatic example of investor impact based on behavior and underperformance was a study conducted by Fidelity Investments in the United States. Now, Fidelity took a look at the Magellan Fund under the management of Peter Lynch. Peter Lynch was a very famous portfolio manager, and he managed that particular fund, the Magellan Fund, which is a global balanced portfolio from 1977 to 1990. So it was a 13-year period. And over that 13-year period, that investment fund had a staggering compound return of 29% per year. Absolutely breathtaking performance by that portfolio manager. So the interesting thing is that Fidelity basically parsed into the data, and they could take a look at the fund flows of assets going into that portfolio and coming out of that portfolio, and that would give them an idea of what the average performance was of investors who were actually buying the Magellan Fund over that 13-year period. And so the article went on to say that they found that the average investor purchasing units of the Magellan Fund between 1977 and 1990 actually lost money. How could this be? The writers of the article went on to say, if these investors were astute enough to identify this investment option, why then did they so consistently perform poorly with this investment option? And some of the reasons were posed by the research was people were chasing returns. So that was one of the biggest ones. The Magellan Fund would often hit, it was a pretty volatile fund, right? So even though the 13-year performance was extraordinary, there were years of significant volatility. So when Peter Lynch drove some really good performance numbers, then that would capture a lot of money. People would want to buy that investment option. But what they weren't fully versed on was Peter Lynch was taking a very aggressive approach to drive those numbers, and so when the volatility hit, what do you think people were doing? Of course, they were selling out of those investments. They were exhibiting behavior that was exactly contrary to what we should be doing during difficult markets. As difficult as it is, you don't want to take a paper loss and crystallize it by selling. Number two, if you've got a high-quality investment or high-quality money manager, if at all possible, try to add back to that portfolio, average back in at good value, and that will accelerate the rate of progress that you're going to achieve on your portfolio in terms of how quickly you can recover from those downturns. So very instructive. So just think about the wisdom of uncertainty. There will be volatility, but more often than not, markets will be up, more times than they'll be down. and there are certain behaviors we need to really be focusing in on to be successful with our portfolios. It's not easy, particularly during times of volatility. So hopefully this was a little bit helpful. Wishing you all the best in your investment journey and your retirement planning journey. Now, with the video will be links to our website. We've got some great resources at Humphries Wealth Group, so make sure you check that out. Again, like I said, if you are new to this channel and you haven't subscribed to it, make sure you hit the subscribe button. We've also got a video that is a video that we think would be relevant to this particular topic, so make sure you click the box to get that video content as well. And like I said, all the best in your retirement planning journey. You take care.